Hi everyone, welcome back to DIY Finance, where we make personal finance easy to understand and you can do it yourself by following this video. Today we will be discussing a fundamental topic in the world of finance. What is investment? Friends, I still remember my first day in office in 2007 when I was just 18 years old. I overheard my seniors talking among themselves about their mutual fund investment and the return they were getting from it. That was the first time when I heard something which was absolutely foreign to me. Since back then, technology was not that advanced and we did not have access to YouTube, Instagram, etc. to guide us. Have you faced the same situation at work? Do you need answers to questions like, what is investment? Why do I need to make investments? What are the methods of investment? Where can I invest my money? How much return will I get against my investment? Are these investments safe or not? Whether you are new to investing or just want to brush up on the basics, this video will guide you through what investment is and why it's so important. Let's dive in. Question 1. What is investment? At its core, investment is the process of putting your money into assets with the expectation of generating a profit or return over time. Instead of letting your money sit idle, you use it to acquire assets that can grow in value or produce income. But what exactly does this mean? Let's break it down. Question 2. Why do I need to make investments? The concept of investment. When you invest, you are essentially using your money to buy something that has the potential to increase in value or provide a stream of income or both. The goal is to make your money work for you rather than just saving it in a bank account. For example, say you invested rupees 1 lakh in a fixed deposit which gives you a return of 6% annually. At the end of 1 year, you would have rupees 1,06,000 balance. That means you earned rupees 6,000 as interest on your investment of rupees 1 lakh. Suppose you reinvested rupees 1,06,000 for a further 1 year at 6% annual interest rate. You would have rupees 1,12,360 as the final balance. That means you earned rupees 6,360 as interest for the second year, which is rupees 360 more than the first year. The importance of investing. Investing is crucial for several reasons. Wealth growth. Investing allows your money to grow over time. Due to the power of compounding, your returns can generate additional returns, leading to exponential growth. Inflation protection. Investing helps protect your money from inflation. While savings accounts may offer low interest rates, investments can provide higher returns that outpace inflation. Have you ever heard your parents talking about increasing prices of items like sugar, oil, gas, etc.? Even samosa prices are increasing day by day. It is because of inflation that prices of items tend to go higher with time. Generally, the inflation rate is around 6% in India. Achieving financial goals. Investments can help you reach long-term financial goals such as buying a home, funding education, or retiring comfortably. What are the methods of investment? Investments can take various forms, including stocks, bonds, real estate, mutual funds, and even collectibles. Each type of investment has its own characteristics, risk levels, and potential returns. Where can I invest my money? Types of investments. Let's explore some common types of investments. Stocks. When you buy stocks, you purchase a share of ownership in a company. Stocks can offer high returns but come with higher risk as their value can fluctuate based on the company's performance and market conditions. Bonds. Bonds are essentially loans you give to companies or governments in exchange for regular interest payments and the return of the principal amount at maturity. They are generally considered less risky than stocks but offer lower returns. Real estate investing in property, whether residential or commercial, can provide rental income and potential appreciation in value. Real estate requires a significant initial investment and involves ongoing management. Mutual funds. Mutual funds pool money from many investors to invest in a diversified portfolio of assets, such as stocks and bonds. They are managed by professional fund managers and offer diversification and professional management. Exchange-traded funds, or ETFs. Similar to mutual funds, ETFs are a collection of assets but trade on stock exchanges like individual stocks. They offer diversification and typically have lower fees. Savings accounts and fixed deposits, or FDs. These are low-risk options that offer modest returns. They are ideal for short-term savings and building an emergency fund. Whether you're saving for a down payment on a house or building a retirement fund, investments play a key role in achieving these milestones. 4. Risk and return. One of the fundamental principles of investing is that higher potential returns usually come with higher risk. It's important to understand your risk tolerance and choose investments that align with your financial goals and comfort level. For example, stocks offer the potential for high returns but can be volatile. Bonds are generally safer but offer lower returns. Balancing your investment portfolio according to your risk tolerance is essential. Savings or fixed deposits. Fixed deposits give us around 6 to 8% interest per annum and come with the lowest risk. Gold. Investment in gold gives us around 9 to 10% return per annum and comes with low risk. Real estate. Investment in residential and commercial properties generally give us around 12% return annually and come with low risk. But they are generally hard to acquire in the beginning as it requires a lot of money to purchase the property. Mutual fund investment in mutual funds gives you around 8 to 20% return depending upon the type of mutual fund you are investing in. It usually comes with high risk as the money is invested in the stock market. Stock. Investment in the stock market generally gives around 16 to 25% return depending upon the stock you have invested in and comes with high risk. Careful study is required to invest in the stock market. 5. Getting started with investing. 5. Getting started with investing. If you're new to investing, start by setting clear financial goals and creating a budget. Determine how much you can invest regularly and choose investment options that match your risk tolerance and time horizon. Consider starting with low-cost index funds or ETFs, which offer diversification and are less risky than individual stocks. It's also helpful to educate yourself continuously and consult with a financial advisor if needed. 6. The role of diversification. Diversification is a strategy used to spread investments across various asset classes to reduce risk. By investing in a mix of assets, you can minimize the impact of poor performance in any single investment on your overall portfolio. For instance, if one investment performs poorly, others may perform well, balancing out your returns. And that's a wrap on today's video about what investment is and why it's important. I hope this helps clarify the concept and motivates you to start investing wisely. If you enjoyed this video, please give us a thumbs up, share it with your friends, and subscribe to DIY Finance for more financial insights. Got questions or topics you want us to cover? Drop them in the comments below. Thanks for watching and see you next time.